Welcome to the Wrestlers class, where we answer all questions. Wait around long enough, and we'll get around to your questions. We have an exciting speaker for you today, and before we introduce him, I want to share a scripture passage. And this is Luke 19, the passage, and this is in Peterson's paraphrase of the Message. While he had their attention, and because they were getting close to Jerusalem by this time, and expectation was building that God's kingdom would appear at any minute, he told this story. There was once a man descended from a royal house who needed to make a long trip back to headquarters to get authorization for his rule and then return. But first he called 10 servants together. He gave them each a sum of money and instructed them, "Operate with this until I return." But the citizens there hated him. So they sent a commission with a signed petition to oppose his rule. "We don't want this man to rule us." So when he came back, bringing the authorization of his rule, he called these 10 servants to whom he had given the money to find out how they'd done. The first said, "Master, I doubled your money." He said, "Good servant, great work. Because you've been trustworthy in this small job, I'm making you a governor of 10 towns. The second said, "Master, I made a 50% profit on your money." He said, "I'm putting you in charge of 5 towns. The next servant said, "Master, here's your money safe and sound. I kept it hidden in the cellar. To tell you the truth, I was a little afraid. I know you have high standards and hate sloppiness, and you don't suffer fools gladly." He said, "You're right that I don't suffer fools gladly, and you've acted the fool. Why didn't you at least invest the money in securities so I would have gotten a little interest on it?" Then he said to those standing there, "Take the money from him and give it to the servant who doubled my stake." They said, "But master, he already has double." He said, "That's what I mean. Risk your life and get more than you ever dreamed of. Play it safe and end up holding the bag. As for these enemies of mine who petitioned against my rule, clear them out of here. I don't want to see their faces around here again." To paraphrase word of the Lord. We are going to have as our speaker today David Gardner. David co-founded the Motley Fool with his brother Tom in 1993. As chief rule breaker, David wears many hats, many Harlequin hats, I guess, including innovator, stock picker, author, lecturer, and media personality. David graduated as a Moorhead Scholar from the University of North Carolina at Chapel Hill in 1988 and wrote for Lou Rukeyser's Wall Street newsletter before starting the Motley Fool. He received Chapel Hill's prestigious Distinguished Young Alumni Award. Since 1999, David has been a member of the New York Stock Exchange Individual Investors Advisory Committee. Since 2004, David has served on the Board of Governors of the Folger Shakespeare Library in Washington. Among his many accomplishments at the Motley Fool, his company, David is perhaps most proud of his conception and development of Motley Fool caps. Tell us about that. The Motley Fool is a multimedia financial services company dedicated to building the world's greatest investment community, reaching millions of people each month through its website, books, newspaper column, television appearances, subscription newsletter services. The Motley Fool champions shareholder values and advocates tirelessly for the individual investor, folks like you and me. Company Glassdoor has named the Motley Fool the #1 best medium-sized company to work for in America for the 2nd year in a row, and congratulations for that. Out of the more than 125,000 companies eligible to win, the Motley Fool was ranked highest, and this is a rating by the employees of these companies. So, David, congratulations again, and thank you for coming. Appreciate your being with us.
Thank you. Well, thank you. That was a very, very kind introduction. I appreciate it. It's also nice to see that the people who are showing up last to this lecture are my own family. Thank you. I really appreciate it. Home team. I'm not used to actually getting to have my son and daughter and wife at my time. Thank you very much for being here this morning, for being willing to suffer fools gladly. Paul, beautifully read. So I believe on the banner it says ethical investing. That's the topic this morning. I know a lot more about one than the other. What I know about ethics, I generally ascribe back to my undergraduate studies, where at some point I encountered Immanuel Kant's categorical imperative, which I think I can sum up in a very undergrad way like this. Before you do anything or don't do anything, ask yourself the implications of everyone else making the same choice you're about to make. And then ask yourself, is that a better world or not? So there's ethics. Investing, we'll talk a lot more about this morning. We're also going to have time for your questions. So if you came here with a question this morning, I'll do my best to answer it in the last 15 minutes or so. So one of my favorite Ralph Waldo Emerson lines is, sow a thought, reap an act. Sow an act, reap a habit. Sow a habit, reap a character. Sow a character, reap a destiny. And so, starting right at the beginning of that, I'm just here to sow a few thoughts this morning. I don't claim, I guess I'm like Jacob, I wrestle with this a lot as well. I don't think that there's any easy answers to decisions, for example, for the Presbyterian Church to divest or not. I know this is a topic on other minds, and you know a lot more about that than I do. I think these are things that we spend our whole lives asking, how can I invest better? Which to me means everything that better means. How can I make more money? That's a lot of the reason we do invest. And how can I improve the world around me, which is really the outcome of the investments that you make. And so these are things that we're constantly learning over the course of our lives. But I want to start right at the beginning of the word invest, because it comes from the Latin investere. And investere means to put on the clothes of. So if you know the word vestment, clothing, vestments, it's the same root, except that it's putting on the clothes. And for me, that has at least three meanings that I just want to briefly explore starting off. The first is, I think it's something that we should all be doing. I noticed, for example, that we're all clothed this morning. We're glad that you are. I know as soon as Adam and Eve tasted the fruit of the tree of knowledge, they ended up with their eyes open, and the first thing they did is they decided to put on some clothes. I think wearing clothing is a really good thing. I think investing is a really good thing. I think it's bettering, but it's not only bettering, it's a social good. And so when you invest, you are creating sustainability for yourself and those around you. When you don't invest, when you do the opposite, from an ethical standpoint, you're creating a situation where you're becoming reliant on others or the state to take care of you. So just that simple idea of making sure you got some clothes on, especially as we get older, we should be more and more likely to have more clothes, because that's just the nature of compounding returns of patience and investing over the course of our lives. That's why the story will always be, if you want to divide America by rich and poor, something I don't enjoy doing. I don't think that's very American to talk that way. But if you do, you're typically going to find that the rich people are older and the young people are poorer. And unless mathematics reverses or capitalism implodes, I think it's always going to be that way. And it should be that way. We should be accumulating if we're investing properly and growing that over the course of our lives. So putting on the clothes, number one, you're holding up your end of the deal for all of us. Number two, putting on the clothes, this is my investing versus trading point. So there's a lot of discussion of investing today on television networks like CNBC, or really most of the coverage that the Wall Street typically gets is very short-term oriented. The last time I was on CNBC a couple of years ago, co-hosting the morning show, during the commercial break, the lovely, talented, professional hostess of that show turned to me and said, I just heard what you said. So you're saying that you still like cloud computing stocks after yesterday. The day before, the stock market had not a great day. And cloud computing, I know a lot of us are familiar with it at this point. Basically, you don't have to keep all your stuff on your hard drive. You can actually keep it up there in the cloud. There's so many different versions of this. The business world has shifted to cloud computing in the last 10 years. And the stocks had a bad day the day before. And this was really her mentality. You still like those after yesterday. So short-term. Incredibly short-term. And that is really the tone that is being set every day when you look at the financial media's, the professional, big-time financial media's coverage of our markets. very different from putting on the clothes and keeping them on, I would say. When we invest at the Motley Fool, and for our members, and I know some of you are here today, it's almost more like putting on the Redskins jersey, although that's been hard to do the last 10 years or so. But you put on your home team jersey and you stick with your home team. I'll talk about that a little bit later, but it's such an important thing to persist, to find things that you want to be loyal to, and allow those things, especially when you purchase shares in them and become a part owner, allow those to persist and grow over time. Put on the clothes. In a world in which everybody's in the financial markets and coverage changing their home team, it seems like every day. The average mutual fund today the average managed mutual fund turns over its assets 70 to 100% per year, which means that the average fund starts with a portfolio on January 1st, and here we are right near the end of the year, and 70 to 100% of that has changed. It's different companies, different shares, different stocks in that fund at the end of the year, and that's the average, and that is the professional world. There are lots of reasons for that. My job is not to cover that, and I'm not a market historian either, but certainly a couple of the reasons are that there is a huge amount of inflow and outflow of the markets. There are a lot of people who are guessing and timing the markets, forcing funds to make some changes. Another is that they really do, just like you hear Wall Street upgrades a stock to medium-term buy and then downgrades it to hold, those kinds of things. Lots of transacting going on, and no doubt also just because transactions themselves generated commissions and fees, a lot of Wall Street set itself up in order to cause you to sell your stock at some point because, ma'am, your broker might say it looks a little high right now, we don't like it at the firm as much, and it's time to move that. So there are a lot of systemic reasons why that's the case, but that is the case. Putting on the clothes, though, putting on the clothes is a very different mentality. So investing is a beautiful word. And trading is a word I don't like as much, and I view them as real opposites, even though a lot of people think they're one and the same. And then the third, teasing out the Latin just a little bit more, I know that Emerson said what I said at the start. I don't exactly know who wrote "Clothes make the man," but there's something about that line that I think is relevant to our talk and our wrestling this morning, is that what you choose to wear, how you have invested your capital, if you're fortunate enough to have some, I think should say something about you. And you should be intentional with that, and you should be thinking about what you want to say with your money. It's much more explicit for most people as they get near the end of their lives, and they write a will. Well, actually, we're supposed to do that much earlier in our lives. And they write a will, and they want to say something at the end about their money to their family. But the truth is that all our lives long, every single dollar that we spend, let alone invest, is saying something about us. And so here again, I'm going to say, clothes make the man. You are and should be showing who you are through your money. Just in the same way as if I went over to your den and you had me in for a drink, and then while you were away, I was just standing there looking over your bookshelf, I would see your books, and I bet I could make some pretty good guesses about you based on what you read. Our books are our friends. As an English major, I still believe that. And so I think that similarly, I should be able to look over your investment portfolio, and I should be able to make some pretty good guesses about who you are, what you believe in, what you love. That's not always true. In fact, that's not true for a lot of people today. A lot of people are disconnected from their money. Either they have it in funds, where they're not quite sure. Funds are proxies for other people to invest your money for you. They're a great answer. The reason that the mutual fund industry in the last 50 years has become a huge boom, from managed funds to index funds and all the above and lots of others besides, is because a lot of us don't have time or interest in picking individual stocks or individual bonds, investments, fixed income, all of those decisions we've kind of farmed out to others. And that's fine. We have a few at the Motley Fool. It's something that in a time-starved world, especially for a lot of people who didn't have education or interest in the subject until their adult years, it's very natural to go that way. However, you're getting an idiosyncratic view this morning as we wrestle together. So I love investing directly in stocks, and that's what I've done. I don't believe it's more ethical, per se, than investing in funds. It's actually much more an individual choice based, in my case, on a love of the game. It's a hobby for me. For a lot of people, it's a pain. It's something they have to do. They don't want to do. But and everything in between. But I'm on this far end of the spectrum. So since you had me in this morning, I'm going to talk a little bit about that. But there's a great line ascribed to Gandhi, and Gandhi never actually said this. You can Google it on the internet. You've probably seen it on bumper stickers. You've heard it in more than one TED Talk. It's be the change you want to see in the world. It's a beautiful line. Gandhi never actually said it, but it's still true of Gandhi, like a lot of those misquotations. It sounds like something he did say, and it's a wonderful. I'm kind of saying that here with your money. So let me then share with you two quick anecdotes to illustrate putting on the clothes. So the first one is a guy that my brother and I encountered in a bar right near our Alexandria, Virginia headquarters in the late 1990s. And he was 6'5", middle-aged. He was dressed from head to foot in leather, and he was just at the local watering hole. And we said, sitting next to him, "What are you doing here?" And he said, "Well, I'm not from this area. It's our annual ride on the Capitol. I'm a motorcycle guy. And there's the POW MIA Veterans Weekend roll through. We as Washingtonians hear the sound if we don't see it every single year." So it was that weekend. And he said, "What do you guys do?" He said, "Well, we teach people about the stock market. We're investors." And he said, "Oh, really? Well, let me tell you my stock market story." And we said, "Okay, great." He said, "Well, I'm a motorcycle guy, and so I don't have a lot. But about 10 years ago, I had $5,000 that I'd saved at the time. And so I gave it to a broker, and he bought 1,000 shares of a $5 stock. And they made like restaurants in the Southeast or breakfast or something." He said, "I don't quite remember what it was. Do you guys know what the pink sheets are?" He asked. And the pink sheets, for those who don't know, these would be stocks that typically no longer qualify for listing because they haven't been very successful. They're usually tiny companies. Often they've fallen on hard times to even get to the pink sheets. And he said, "You guys know the pink sheets?" We said, "Yes." He said, "Well, I still follow it today. But 10 years later, it's gone from $5 a share to 25 cents a share. So my $5,000, is down to a few $100. And what I've learned is," said the motorcycle guy, "is stock market's a great big gambling machine." And we said, "Do you ever think of investing in Harley Davidson?" He said, "No." "Well, it's a public company." "Well, what's that?" "Well, it means you as a member of the general public can become a part owner of Harley Davidson." And we went back and checked the numbers. Harley Davidson, over the course of those 10 years, it's a good 10 years, went up about 100 times in value. So those $5,000, if he'd invested in what he knew, in what he loved, in what he was riding every day, in what he was being surrounded by every day, would have been worth $500,000 instead of $250. And so you end up realizing you're somebody who wasn't wearing the clothes. And why wasn't he wearing the clothes? Lots of reasons probably, but one is he'd never been taught to think that way. Because he, like so many Americans, hadn't received any real schooling on finance and money. And when it came time, he gave it to somebody he didn't know, who put him into something he didn't understand. It didn't do so well. The person was probably not motivated to perform for him. That financial advisor relationship probably wasn't pure. And he ended up, at the end of the day, concluding that the stock market is a great big gambling machine. It's the exact opposite. The stock market is nothing more than your opportunity and mine to become part owner of the greatest things that we've come across in our lives. To the extent we have some capital, we should be doing that. Whether you're a big Apple computer fan, or you're a Netflix user, or you love Chipotle, or your kids do, the list goes on and on. These are great companies. Whole Foods. Not only are these some of the best exemplars of capitalism today, they also happen to be some of the best performing investments. And that's not random. They're directly connected, and I'll cover that in a little bit. So that's anecdote number one, Harley guy. That's one of my timeless stories when we did a PBS Pledge special. That was my money story at the end, still there somewhere on VHS tape, possibly purchasable on the internet.
Poor guy.
Maybe on eBay, resold versions of our Motley Fool PBS special. But that's number one. Number two is also a personal anecdote, and this one is me turning 25. And at the age of 6, in 1972, my father's father died, and left his money in trust to be managed by my uncle, who's a very talented money manager, who invests. And it was set up so that each of the grandchildren, as they turned 25, would take over their portion. So on the day that I turned 25, I flew to Lancaster, Pennsylvania, which is where that portion of my family is. And in front of me was laid out the brokerage statement that I would be taking over. And the amounts aren't important. In fact, clearly I still have my day job. But there was something that I've said since then. I wish especially every young person, really every person could see what I saw that day. What I saw that day was a portfolio of about 25 stocks. And the year since I was turning 25 was 1991. So the money had been managed from 1972 to 1991. Most of the 20 or so stocks in that portfolio had been purchased in 1972, 3 or 4. And it looked like this. Martin Marietta, cost basis $3.43. Today, 66. Berkshire Hathaway, cost basis low. Today, 50 times that. The list went on and on. Not all of them were as great as Berkshire Hathaway. Very few companies ever will be. But up and down the list, I saw cost bases of $10 or $12 a share, and present prices quoted at $100 or more a share. An incredible eye-opener for a young person who ended up mistakenly, not even meaning to, creating his own company that would one day use the internet to teach as many people as possible about investing. So that has always stuck with me ever since. That's what investing looks like. And it's really so simple. And that's why I don't have any hot tips this morning. Maybe you'll have some hot questions for me a little bit. But it really doesn't need to be much more complicated than that. It's finding great things, and then it's just leaving your money in. And the hardest thing to do for most people, it's not playing games with guessing market direction or worrying about the future, which has been very hard to do. There's a beautiful book called The Rational Optimist by Matt Ridley. I recommend it to you all if you've not read it. And one of the things he shows is that over the course of history, the right bet, the smart money, was always optimistic. And indeed, in a world in which, by so many measures today, we are better off than we were 30 years ago, 50 years ago, than almost any culture was 100 years ago, 1,000 years ago. It's been the right bet, and it remains the right bet. So, again, an idiosyncratic speaker this morning because I'm an incorrigible optimist. If you can only tie me in your optimism, you can't ever do mine. And I don't believe that I'm wet behind the ears or a greenhorn or this is the wrong way to look at things. I think this is the right way to look at things. Because I think that not only is it clear to me that technology is speeding up, and while that naturally brings challenges and some downsides, no doubt, technology is a tool and it can be used for good or ill. But for the most part, most of us this morning, even though we're all fallen and sinful people, we still are here because we're generally trying to do the right thing. And it turns out, I don't think that that is confined to this room or this group of people. I believe that's true of most people, worldwide. Worldwide. One of my formative experiences was going to Syria as a 21-year-old. And one night, driving on a highway that was unlit in the so-called suicide seat, with my friend driving to my left, all of a sudden we began hitting rocks underneath the car on this dark highway. We didn't know what was happening. My friend lurched the car to a stop, and all of a sudden 20 flashlights were cutting through the night air running toward us. And we couldn't figure out what happened. We were the young blinking Americans getting out of the car that had been wrecked for some reason. And one of those flashlights went right past my friend, got in the driver's seat and started going, and the others, as it turns out, were all guards at a checkpoint on the Syrian highway, and my idiot friend had not noticed that we were supposed to divert off to the side. They'd set up a rock cairn on the highway to come over and just check into the guard point, and we just ran our Peugeot right over there. And for the rest of the night, they hosted us. We had coffee in their guardhouse. We had watched bad American 1950s black and white TV, muted, but that's just their entertainment. Played backgammon with them. The next morning, they drove us into Damascus, towing our car, our wrecked car, where the gentleman who ran the dealership, the rental car dealer in Damascus, a very elegantly dressed older man, said, "I am so sorry what has happened to you. You are guests in our country, and this should not have happened. Here, have another Peugeot." Syria is a scary place today, but it's a scary place not because of gentlemen like that, who are, in my estimation, the majority, but just because of, like a lot of other cases, a few crazy people that set the tone and the headlines, and unfortunately sometimes do wield scary power. But so pulling myself back from my brief optimistic rant, you can see why I stay invested, and especially in a world in which no one has demonstrated a regular capability to call the short-term movements of the stock market, and yet so much of the coverage is about that. Where's the Dow going to be? What do you think this spring? I heard there's going to be a big sell-off in the fall. These kinds of comments, so short-term, so market-focused, so misaligned with the simple act of taking ownership in the form of common stock, whether it's directly or through mutual funds or whatever floats your boat, and just allow that, in frozen terms, let it go. So that's a lot of what I think about when I think about investing, and I think there's something ethical about that too. So Harley Davidson versus Lancaster, Pennsylvania. Just setting up a little bit of a foil there for you to try to illustrate my own experiences. I see it's 10 o'clock. Maybe I'll go for 10 or 15 minutes more, and then I'd love to have 15 minutes of questions. And if there are a lot of hands, then we'll go lightning round in 1 minute a question and fire through. So Warren Buffett, my favorite line from Warren Buffett, in fact, at the Motley Fool headquarters, it's the biggest font, blow-up quote anywhere in our office. His great line, "I'm a better investor because I'm a businessman, and a better businessman because I'm an investor." These two things are obviously in Buffett's mind and mine, I hope yours, tightly tied together. There's no better source of advice for me helping run a business or an organization of any kind, not for profit, for profit, an organization of any kind, than to be an investor, to be constantly scanning the skies for the best things that I can find and learning from how they do that over there, and then making that a part of our organization. On the other hand, there's also, for the investor in me, there's no substitute for being a businessman, being in the game myself, trying to figure out the internet as an entrepreneur the last couple decades, and then use that to inform my own stock selection. We tried that, didn't work so well for us, or I see that they're trying this, that's a good idea, right? Those two things are really related to each other. And it's not on a two-dimensional plane, that circle. It's actually three-dimensional. I think it goes like that, because I think as you get better at one, you get better at the other, and I think things work out like that. So I love that Buffett line, and so you can see then, if we're going to talk about ethical investing this morning, I think part of it is to talk about ethical business and what that means. And business is a generic term for me. It's just professional organization, whether you work for the government, whether you work for a private company, or anything in between. There are companies that really do capitalism well. Sadly, the ones that don't often get the headlines. And sometimes, in 2008-9, the ones that don't really hurt everybody else. When there was a near financial systemic collapse based on how things were run at the biggest banks. So that's something that we all have to guard against. But there are 4 foundations to good business that I want to just trace out briefly for you, and then I'll put a label on it, And I'll give you a book recommendation if this interests you. Here they are in order. And these are the things that I actively look for when I pick stocks. You're not going to find all 4 of these at every organization, but you sometimes can start seeing that 3 of them are there, or that they have a heart for a couple of them, right? So then the first one for me is purpose-driven. Can you see, or does a company articulate clearly a purpose to what it's doing? For us at the Motley Fool, we have a simple purpose statement. It's to help the world invest better. And that's a lens that we all wear, a pince-nez perched on the end of our noses for our 350 employees or so at the Motley Fool. That's how we think about what we're doing. And we say it, and if you're a member of the Motley Fool, you should say that back to us. You should know that that's what we're trying to do. And you can judge us according to that. And if we make mistakes, it shouldn't be that our purpose was mistaken. It should be that we failed to live up to it adequately. So finding purpose-driven institutions, for-profit, not-for-profit, institutions that really invest themselves, wear the clothes of that purpose, really critical. Number two is what I'll call multi-stakeholder orientation. And of the 4, I believe that this is the most important. And it's simply this. Traditional American business, lots of Fortune 500 CEO letters in the annual report for decades, said that the purpose of the business is this phrase, quote, to maximize shareholder value. That is why business exists. A wonderful, otherwise wonderful economist, Milton Friedman, defined business in those terms and set a tone for a generation with that line. And there's something to appreciate about that. The shareholder value part, I like a lot. But what's happened with a portion of American business, which was dominant, but I think changing, was if you have just one set of stakeholders and you're trying to maximize their value, what does that mean for everybody else, and what does that do to the system if you get up above it and look down at the trees? Great organizations will identify their stakeholders. I'll give a few typical examples. Your customers, your employees, no particular order to these, your shareholders. Let's go with your community, perhaps. It might be your nation or your government in some cases. And the list goes on. Your board members. For each organization, they should be clear, explicit about who their stakeholder groups are. And then all the best stocks that I've found persistently over time do a pretty good job at trying to create a win for all of their stakeholders. That's multi-stakeholder orientation, coming out of a world in which you are maximizing shareholder value. Maximizing shareholder value is what happens when people ascend high enough, at an advanced enough age to become CEO of an organization, will hold that position typically for 3 years, will be looking to create short-term stock rewards for themselves and their shareholders, sometimes their employees, sometimes Wall Street. And then after 3 years, they will move on, retire and move on. And so you end up with incredibly short-term, unpurposed management. By the way, it can work. There's some great companies that have done that. GE kind of did that for a long time, although usually it's with CEOs that stay there for 10 plus years, not the standard 3 to 5. But when you really ask, what is a win for our customers? What's funny, I'm not the CEO of my company, I'm happy to say my younger brother is, but when you're in that position, it's really interesting to look at each of your groups, right? What do employees want? They want to be paid more. What do customers want? They want lower prices. What do partners or suppliers want? Well, they want to be right up front in the window. What do shareholders want? Instant money, double my stock. You're balancing every one of those competing interests. And when you, in fact, purpose to create a win for all of them by making decisions across the system, as opposed to isolating one of those stakeholders and maximizing their value, that's great leadership, and that's true value creation that occurs over the course of time. That's number 2. The third and the fourth are pretty easy. Number 3 is is leadership, is servant leadership. Servant leadership. Is it a company where the CEO gets the corner office, the the great parking spot next to the door, the list goes on, or is it the exact opposite? Does the CEO get no better parking spot than anybody else? And is there a lot of democratization, no real regimentation to how the office is even set up? Now, for different cultures in different workplaces, there's not one size fits all. It's not that everything should be egalitarian. You probably don't want to walk into a bank and see the CEO dressed in jeans and sitting next to customer service. So maybe that doesn't work as well in banking, but in general, that sense of servant leadership, just as true in the church, just as true in government, leadership of all kinds, so true and so important in for-profit capitalistic entities. So many of the best companies, again, have done that. Costco, Jim Sinegal, what a great CEO, what a great stock. I'm sorry to say I haven't owned it, but the 20 years or so that Jim Sinegal oversaw Costco, it's an amazing performance, up 50 times in value or more. And Sinegal never had an assistant, and he answered his own phone. You could call him up. We did. Interview him on a radio show. He just picks up with Sinegal. And so it's that kind of accessibility, that exact reverse of what you would expect from big-time corporate America. So powerful, because not only is it just a better way to be, I think, but it sends such a great message to everybody around you, especially setting a tone for employees. So, by the way, the wonderful dynamic to all this is that when you make your employees really happy, they tend to make your customers really happy. When your customers are really happy, they tend to shop with you more and or be willing to pay higher prices. When they shop with you more and pay higher prices, you have greater profits and greater sustainability. And when you have greater profits and sustainability, you have a better performing stock price. And when you have a better performing stock price, if you're going to follow me around the circle here, it's not just this, it's this. When you have a better performing stock price, you offer shares to your employees as a portion of their compensation. That makes them happier, which pleases customers more. They shop more with you and spend more. The list, it just keeps going, right? That dynamic is in place. And the fourth and final aspect I'll mention is just the culture of a company. Whole Foods is probably one of the great modern day exemplars of an interesting and amazing culture. Just a few things about Whole Foods, which has been a tremendous performing stock the last 25 years. For one thing, every one of the Whole Foods stores, if you've ever been in one, is managed autonomously. They're not taking a line from corporate. They're not forced to do anything. The Whole Foods on Wisconsin doesn't know what the Whole Foods in Old Town Alexandria is doing unless they want to share. They're autonomous. Number two, everyone at Whole Foods can see what anybody else at Whole Foods makes for salary. Open book. And that's not just some fly-by-night.com experiment in 1999 somebody's trying getting publicity for. That's for a company that has tens of thousands of employees that has been doing this for 30 plus years. There are a number of other aspects that you can look at if you ever want to study Whole Foods that show what a unique and interesting culture that is. But culture, especially when you, I really think no matter what organization, whether again we're walking into some branch of our government here in Washington, D.C., certainly the military has this. Any for-profit, any not-for-profit. I'm a culture hound. I think you should be too. Maybe you are. I want to see and feel something unique there. True of our church. Any place you should see and feel and be able to put some adjectives and put some clothes on the bones of what that culture looks like or feels like. You should be able to describe it as any. I think all the great for-profit public companies really get this. And so when you put all four of those together, purpose-driven, multi-stakeholder orientation, servant leadership, and what I'll call a conscious culture, where you're doing it consciously, and people can see it. That's the way to do capitalism. My book recommendation for you is a book called Conscious Capitalism, which basically propounds those four principles, and it was written by John Mackey, who's the CEO and founder of Whole Foods. And full disclosure, home team here, he's a member of our board of directors as well. So if for some reason you think that I'm conflicted, you don't have to read the book. I think it's a great explication of how business should be and is, I'm happy to say, done beautifully in a way that creates value for everything around it. When you do that with a business, with an ethical business, when you do that, everyone wants that thing to succeed. Everyone does. The only entity that doesn't want that organization to succeed would be a competitor, who might find it really hard to compete against. But because I've got to know John Mackey some over the years, I know that he even views his competitors, in a sense, as a stakeholder, which is an interesting way of thinking about things. All right, so time is short. We talked about investing. We talked about business. I gave you my categorical imperative view of ethics. I'm really not trained in any way about ethics, but I hope that there's an ethic that seems to have run through so many things that I've said, and so maybe I've sown a few thoughts, which might reap an act or two. But I never presume to do so, especially because I am a fool, and so we really do. If Paul hadn't read the "Suffer Fools Gladly" line, that's often a line I will use and reuse in my talks. So if anything has been useful to you, I'm glad. And maybe I've sparked a question or two. Does anybody have any questions? Why?
One of the beauties of the Christian faith are the paradoxes. And you look at Christ's teaching, and on the one hand, he talks about the lily of the fields. They don't worry about their dress and what have you. He talks about the fool who stored up everything in his warehouse. Okay. On the other hand, one of the parables that I've never understood fully is why the person who buried the one talent, that talent was given to the one that had the most. So that's a paradox. Put that in the concept of the stewardship notion that we have in Scripture, and comment on it.
Yes, thank you. It's really one of my favorite observations. I mean, you really eloquently painted it out there. And so I do have a thought. I do have one thought, Clive, because I see this all the time in investing. Here's a simple paradox. Well, let's go with the classic epigrams. Look before you leap. So let's just briefly reflect on that line. Look before you leap. So applied to life, business, investing, it's implying that we should be cautious, we should be thoughtful, we should look before we leap. We can think of the times looking back on our lives where we didn't. We left, and we were burned. And perhaps some avuncular person put their arm around us and they went, Sally, look before you leap. And it sounds so wise, and it's right. The problem is, over here, he who hesitates is lost. Let's briefly reflect on that. Can you think back to a time in your life where somebody offered you a great opportunity and you said no, or you paused, or you mistimed something? Your heart might have been in the right place, but you didn't go for it. And you look back and you think, if I had done so, things would have been better. You hesitated and you lost. And somebody, a avuncular person, with their arm around you, Sally, she who hesitates is lost. Both are true. Both contradict each other as directly as I can think. There are other good examples. I call these paired epigrams. Another quick example is absence makes the heart grow fonder. Very true. Out of sight, out of mind. Very true. Both true. Both directly contradict each other. So here's how I've come down on this, because this happens all the time in investing. Do you take a risk, or do you not? And I think that true wisdom is holding both of those thoughts in your mind, being aware that both are right, and then applying the right one to the right context. So I see a lot of times people who, they get an idea in their heads about investing, and this is their thing. It'll be like, what's an example? I'll pick a particularly silly one, although you hear it all the time, but I think it's silly. So my stock doubled, so I sold half, and now I'm playing with the house's money. There's about 3 things wrong with that, which I won't strain. But basically, people get that in their head, and then that's their thing. Now, on the other side, that can be true. Sometimes that's a good move. On the other hand, you just sold half of your Berkshire Hathaway at the start of your 30-year relationship, where you would have made untold amounts more if you'd not followed that. But sometimes, if you do follow that, it was not a good company. You sold half, and that was good because it didn't do so well. So you're glad you didn't just hold it into oblivion, right? So I think each of these is a tool. Each of those biblical examples, or my paired epigrams, is a tool. You want to load up your toolbox with as many of those as possible. You want to have as many Bible verses, stories, anecdotes, possibilities, epigrams in your head as possible. And then you want to make sure that you become a master over time at pulling the right tool out. A hammer, not a screwdriver, for that hammer moment, and a screwdriver for the other one. That's my best shot at that. It's a great question. It's actually one of my favorite kind of observations or points. Hey, yeah.
Having an engineering background, I recently read Flash Boys, and thought it was fascinating on how they combined the need to, shorten the distance between Chicago and New York by fiber optic cable, so you could save literally milliseconds on trading to make clouds of money. Mm-hmm. People want to pay huge amounts of money for this, straight fiber optic cable. So when you talk about trading, is there a difference between trading and high frequency trading?
Right. So
is there different evil as part of the other one?
So Flash Boys was the most recent book by Michael Lewis, the very acclaimed writer who wrote things like Moneyball, which I loved, or Liar's Poker back in the day, the new thing. He's written a lot, and he's a beautiful writer. Flash Boys is about high-frequency trading, and I haven't read the book. I have interviewed Michael, and I'm aware of it, having been on the New York Stock Exchange Committee some. But in general, what's happened is that over the course of time, we moved from Wall Street being driven by people with pieces of paper, and you saw them at the nightly news throwing up their paper as the bell clangs, to machines. And as soon as you start to automate with machines, a couple good things happen, actually. There's a lot more liquidity, a lot narrower spreads. If you're an investor, you were used to 30 years ago, the bid would be 15.5 and the ask would be 16. And that would be a $0.50 on $16. That's a significant percentage. These days it's down to a really tight spread, so that's good. On the other hand, what happens is that there's a lot more trading. Computers are just in and out. And if you're trying to trade, another reason I don't like trading, if you as a fellow human are trying to do this, you're competing against machines, and I don't think you're going to win. But what ultimately has happened is that the faster you could route your computer to fulfill a trade, you could get in ahead of the other computers and charge slightly more and then pocket the difference. And when you do this on a micro level, it doesn't really mean much. If you or I had a little computer like this with our small amount of money, it wouldn't count for a lot. It would be really tenths of pennies for us. But when you take that and you put that across billions and billions of dollars, it can make significant money for the guys who have their machines set up faster than others. In the end, I don't have a lot to say about this other than it's not a game that you or I is going to play. It's basically a Wall Street phenomenon. It's good to be aware of it. I'm glad that Michael Lewis brought the world's attention to it. At the same time, I know as a fellow fool, you and I don't even need to get caught up in that for the most part, because from my standpoint, I tend to buy and not really sell very often, if ever, in some cases. And so that actual transaction done for pennies is so simple and easy for me that in the end, I'm glad that Michael's brought the world's attention, but even that business hasn't been that great a business, because what happens, of course, is it gets commoditized, and those tenths of pennies become hundreds of pennies, and even smaller as the computers battle each other. Yes?
The term ethical investing means often, a lot of the time to people, investing in companies that are thought to do no social or political damage. Could you fit that into the context of what you
Yes,
said?
thank you. A very good question. So the phrase often uses socially responsible investing, socially responsible mutual funds. Sure. The question is, what about socially responsible traditional investing? There are funds named that, where you are buying funds or companies that are perceived by you or the world to do little to no social harm. And could I fit that into the context of ethical investing this morning? I do see there's about 5 minutes, and I do see a lot of hands, so I'm going to give a 1-minute answer, which is giving it short shrift. But So I believe that the most ethical thing you or I can do is make sure that our money describes, just as we do with our consumer dollars, our investment dollars would largely do the same thing. There's an alignment and a one-to-one there. So for example, my mother was a smoker. Just to be provocative, I think that it was a socially responsible, ethical thing for her to do, if she wanted to buy shares of Philip Morris. On the other hand, I don't really like smoking, so I'm not going to invest in Philip Morris. Another example, for me, I really don't like things that lose people money. So I don't like casinos. I've gambled at casinos. I think it's kind of fun. It's a low-key thing. But just as a stock recommendation from me, or something for my portfolio or yours, I avoid those companies because I believe they're in the business of essentially making people poorer, which seems to be at direct odds with the purpose of my company. So I think in the end, we need to know ourselves best. And the biggest thing most people need to do is align their money with their ideas of the world. And I will say that if you mail that off, if you give that off to a fund manager, you're not necessarily aware of exactly what they're doing, or they're presenting their list of what they think is ethical or not. Now, they have a lot of resources and can make some good decisions. So I think it's perfectly fine to use the Calvert Social Index or other funds that are based on those kinds of things. But for me, there's a direct one-to-one, most of all, about making sure your money is aligned with your belief. Thanks for a good question that I gave short shrift to. Yes, sir.
First of all, you gave a very enlightened message for all of us. It was excellent. You had mentioned Berkshire Hathaway and Warren Buffett.
Yes, sir.
And he has had a big presence in this area with Geico, serving newspapers when he lived here at the Westchester Apartments, went to Wilson High School,
You bet.
which is just up the street. Have you had an opportunity to share with him, because it seems like you have much the same philosophy?
Well, we do. We've learned a lot from Buffett, and so I've met him before, and we have done a few things with our organization with him. We have a lot of Buffett fans, not just in our small company, but among a much larger reach of our membership. And so it's very natural that we have probably lionized Berkshire Hathaway more often than not, even though, and I'm not a big student of Buffett. Like at my company, we have at least 30 people who know Buffett much better than I do, so they're not here to speak this morning. I am, so I'm not as much the Buffett follower, but certainly, you know, he's been called out occasionally for taking some hardline stances. But I think that, take it all in all, he's just been an amazing exemplar for the last 50 years or so of the value of doing business well. Everything from his decision, typically when he requires companies to leave existing management in place, not just fire them all and bring them all under the Berkshire thing, right? There's just how he does what he does, let alone what the results have been of what he's done. Says so much good to me. Yes. Yes, sir.
Often you say business and investing, and yet business is often driven by Wall Street's short-term trading attitude. Many firms go private in order to avoid that. How do you wrestle with that, I don't know, paradox?
Mm-hmm. So I think you're right. Wall Street can definitely drive businesses, and it's balanced. There's a look before you leap, and a he who hesitates is lost to this. Sometimes companies are, for whatever reason, being complacent, and then some of those corporate raiders sometimes do good things. Carl Icahn moves in, and they start shaking them out of their complacency or their shareholder unfriendliness. On the other hand, the idea that you have to hit your earnings each quarter or your stock's going to sell off dramatically and you're going to lose face with Wall Street sounds more toxic than beneficial to me. So I think where I come down to my 1-minute answer is that I love the companies that tend to resist that. And there are great examples of it today. Amazon.com, probably one of the great exemplars of that in the last 25 years. A company that truly, truly does look, think, and act 5 to 7 years ahead. And often I will point out in closing, in my last 10 seconds on this one, that companies that have strong founders with significant stock ownership tend to resist Wall Street's hard hand. and can think longer term. Often those family businesses are the longer term thinkers and players. And so we don't have to invest in every stock. We can invest in just the best ones. And I think the best companies are not Wall Street driven, as I bet you do too, Bruce. Yeah. All right, so I'm not quite sure. There are more questions. I'm always happy to do it. But I'm getting the hook here. On behalf of
let's take one more.
Pastor Rennick, etc. Yes, sir. One more. Yes.
You hinted this, but I'm still puzzled on why our church divested itself from Caterpillar. And the reason it wasn't spiritual, maybe political, but how do you feel about that?
Well, I mean, I first of all, I admire Caterpillar for the most part. I mean, just not knowing anything about what our church is doing, I know a little bit about it, but pretending I don't, on the face of it, I think Caterpillar is a fine company. Once you get really big, it's hard not to be doing something that somebody's going to think could have been done better. Caterpillar's been incredibly generous. For example, some of the microcredit organizations that we're affiliated with, Caterpillar's been a big donor, etc. All that said, this to me is another classic example of look before you leap, or he who hesitates is lost. There's a golden mean that we need to find. There's the right decision in the right context that anybody needs, whether it's a church making a decision or you or I. So I don't have ultimately enough knowledge about the situation. And even if I did, this is one of those 6 one way, half dozen the other. Do you pull your money out to send a message, or did you just cause resources to be drained from people who actually needed it? It's like, should you employ people below cost in foreign countries? That sounds wrong because you're paying less than you do here. At the same time, if you pull out, there may not be any jobs at all for them, right? So all I can say is I see both sides of it, and I hope each of us does, and then we take our best shot.
We'll have to close here. David, thank you so much.